Hello, this is Mark from tradingform.com and welcome to this video on how to trade the S&P 500 using the impulse indicator. Now, the impulse indicator was developed by Dr. Alexander Elder, and he describes how he came up with the idea for the impulse indicator during the 1990s, and this was the time of a strong bull market for stocks. Prices were going upwards and upwards, and he wanted a system that would enable him to trade on momentum. Now, the impulse indicator is designed to do just that. It uses the EMA and the MACD as part of the calculation. Now, if both of these indicators are pointing upwards, we have a positive impulse, or an impulse of 1. If both of them are pointing downwards, we have a negative impulse, or an impulse of -1. But if they're pointing in different directions, we have no impulse, or an impulse of 0. Now, I have in front of us on the screen here the calculations for the impulse indicator, and I've actually taken these from the spreadsheet that comes with the ebook that I have written. It's called 21 More Technical Indicators. There is a link on the screen at the moment. It's available in the Amazon Kindle bookstore, and it has lots of different technical indicators, chart patterns, ideas for trading them, and it comes with a free spreadsheet that you can download and start using straight away for testing your own strategies. So what I'm going to do now is I'm going to have a look at the results. I should just mention over here on the left, this is the price data for the S&P 500. I've used a 20-year look back period, which is quite a decent amount of time, and I'm using the daily data. I've programmed in the strategy here, and I'm going to have a look at the results. Probably the first thing that would get most people's attention is the capital graph here, which is pointing for most people in the wrong direction, pointing downwards. Having a think about why these results occurred, we can probably go back to the idea that this impulse system is designed for momentum stocks during strong market conditions, and I'm testing it here on the S&P 500, which is of course an average value of 500 of some of the largest companies in the world. So what we're really getting is a nice average value, but we're not going to get the strong momentum that we can do for stocks when prices are going crazy in a bull market or crazy in a bear market. So really these results shouldn't surprise us that the impulse indicator is not much use trading it as it is meant to be used in trading an index such as the S&P 500. Well, I think probably what most people are thinking, certainly the first thing that occurred to me, is pretty much all these trading periods, all this whole time, it was a good opportunity to not use the impulse indicator. So what would happen if we reversed it? Well, I programmed that in and we can have a look at this. And we can see that we have this same dip here during the late 1990s, which was the best market conditions for using the impulse indicator. But since then, the impulse reversed has actually been significantly better, and in fact has a positive expectancy, positive win percentage over almost the entire time period. Why is this the case? Well, let's have a look at some sample trades. Now I'll just zoom out a bit. We've got exactly the same market here, the S&P 500, and I'm going to zoom into some fairly recent trades that occurred during 2015, and we can get an idea of exactly what's going on here. Now I've reversed it, which means Slightly counterintuitively, we're getting trades, long trades when the market's weak and short trades when the market is strong. Anybody who's traded and been frustrated with markets will know that quite often we do get rallies after a weakness, a seeming weakness, and we do get drops on strength quite frequently. So I'm going to zoom in here to a period of mid-2015, and we can see what I'm doing is entering on a downward bar. Of course, I'm entering long on a downward bar, but I'm only entering long after we've had a neutral period. I'm trying to avoid the slightly more whipsaw style when we go directly from one to another. So we have a neutral period, then we go short, and I'm buying at this particular time. I'm exiting on a neutral bar. So you can see we've gone here from immediately short, and we're closing out at the end of the next day for a small profit. Now we're going short here again. We have an even bigger bar. We almost get to the bottom, in fact, of the low point here, but we stop there at the close. So using our system, we go long again at this time. Now we're in the trade and we can ride up here. We're ignoring these green bars till we get to the top and we have our first neutral bar. So this is the system working in pretty much absolute perfection here. We have weakness, we get in at a good price. The market, as it quite frequently does, reverses on a dime and moves straight upwards. We take advantage of this positive impulse and we exit near the top of the market when momentum to the upside has now slowed. Okay, so we can go along here and we have an example of a short trade. You see we've got a zero positive impulse here. We've got a positive impulse and we have a nice price that coincidentally in this case coincides very closely with the highest price we're going to see for a good period of time, and we're following it downwards here. At this point we really are not knowing at all whether our trade is going to be successful or not, but we have a succession of up and down movements indicating no strong direction before, out of nothing, during August we have a sharp market fall. Now we're riding this trade down all the way almost to the bottom. Now we do lose a little bit of potential profit as we get out on a strong bull candle, but you can see the difference between these two prices would add up to quite a nice, what are we looking, somewhere around 60 odd points worth of a trade. Now again, this is a perfect example of a trade. They don't all work out as well as this, and of course there are a significant number of losing trades, but this is, historically speaking, the best way that I've identified to be using the trading with the impulse indicator on the S&P 500. Now these results have been carried out. This is a trade-informed backtest model. Now if you'd like to use this model or a similar model, you can certainly do so. If you want to click on the link on the screen, there is available a wide range of trade-informed models that enable you to test your own trading strategies, to do this work for yourself and develop and refine your own systems. Now, I can't emphasize how important I believe this is for every trader wanting to refine their work and become more consistently profitable. Now, I hope you found this video useful. If you would like more information about the financial markets, trading using Excel and backtesting, please go to www.tradeinformed.com.